Okay, and welcome to this week's edition of Self Wealth Live here in the studios at our own homes. Jason, how are you? How are you this afternoon?
Yeah, all going well in the studio, Rog, and ready for another good chat about stock markets and stocks and all things like that.
And other things such as running. Sometimes we chat about running. You know, you're a big runner, aren't you, Jason? Maybe you can tell us a little bit about that at the end if we've got some time. All right.
Yeah, anyone's got some running stuff they want to talk about, put it in the chat, and we can go through it.
Exactly. All right. So, I'm a bit close to this camera today, but it's okay. What I was going to talk about, ask you first off, Jace. Look, first of all, welcome to all our viewers that are coming in on a week-on, week-off basis. We much appreciate you coming in. Feel free to tell your friends about whether it's just this live, obviously it's nice, or even Jason's service or Self Wealth. Make sure you obviously mention us. We are doing this just as a way to hopefully educate people on the charts, because I feel like that's once again a missing part of a lot of people's analysis around stocks, especially as we traditionally are always listening to analysts talk about companies, and most of the time most people don't really understand what they're talking about anyway. I just always felt that technical analysis or charting was easier to understand. It can be simple if we really make it simple, and I hope that's what we're here to do. Jason, do you agree? Or
yeah, I think so. I think the charts can also be dangerously simple for a lot of people. A lot of people will start just drawing lines on charts. They might read the first couple of chapters of a book and start just trying to go, oh, look, this is all pretty easy. And good chart analysis it's like anything. Good anything takes years to develop. And it's just one of those things. You've got to train your eye to see the patterns, see the price action, interpret it. And you can't really do that in an afternoon on YouTube, trying to self-teach. So I think it's highly accessible. I think charts are highly accessible to people generally, but you still got to put in the work. And if anyone looking for a quick fix, the charts probably aren't going to be your savior either.
No, you're absolutely right. Exactly. You've been doing it for 30 years. I've been doing it for just under 10, and I still got a lot to learn, right? So, but I think if we all stay humble, we can actually make a success out of all this, just like you obviously have, Jason. So, and I hope to offer that hope to a lot of people that want to get into the stock market. Myself, that's one of my goals. Sort of when I joined Self Wealth was, to help educate people as well as obviously bring in more business to the company. But let's be honest, every business needs to make money, right? So, it's my pleasure to have you, Jason. It's great to continually have you week in, week out and help us out while we do, right? So guys, don't forget, this is, we try and make it as open, although you can't speak to us. Put in your questions for us around technical analysis or charting, understanding charts underneath here. And also, please send us any stocks that you want us to analyze on the charts, and we will do our best to show you what it's doing right now. We can't predict the future, obviously, so don't ask us what it's going to do, but we can have a go at showing us what it's actually doing right now. So, all good. All right, Jace, did you want to show us your disclaimer, please?
Yeah, and just quickly, charts aren't a crystal ball of the future, but what they help us do, they help us assess the possibilities. They help us see scenarios that could unfold, and then we use risk management strategies to navigate those scenarios. And that's what it's all about. I think a lot of people get the wrong impression that it's, and there are branches of technical analysis which do try to predict. I stay away from those because I don't think we can predict what's going to happen. But we can work with possibilities, with probabilities, and with strategies. And for me, that's what the charts are all about. Now, having said that, everything today, general commentary only, doesn't take anyone's personal situation into account. And just quickly putting up the disclaimer we do each week, that just goes through that. And it also mentions that I'm not part of Self Wealth. I'm from Motion Trader. So my stuff's up the top, my licensing details, etc. And you'll see the Self Wealth licensing details in the second section. So general commentary only.
Yeah, fantastic. All right. Thanks, Jason. All right. So before we get on to the markets, actually, you said a key word to me then, all right, and that is strategy, and having a strategy, how important it is to have a strategy in the stock market, in the share market, all right? And I was just speaking to a colleague the other day, they're just getting involved, starting to get involved in the stock market. And I said, look, if anything that you do, in my eyes, is don't just buy a random stock because you heard it from a friend. Rather than buying a random stock, find some sort of system or find some sort of strategy that you might help you long term, right? To be involved long term, that you can, whether it be, investing. I didn't really get too much into it, but I just said find a strategy and test it a little bit somehow, right? So this is my question probably for you right now, Jason. How much emphasis, and I know you could take 2, 3, 4, 5 weeks talking about this, right? But in a nutshell, how much emphasis do you put on back testing strategies and systems?
Look, the first question I'd ask someone is what, say someone's just bought a stock and made some money. It's I think one of the first questions you could ask them is that repeatable? Could you do it again? And you then ask, well, if it's repeatable, just on the back of a piece of back of an envelope, jot down your process. And if you can't do that, if you can't jot down a process, well, then it's not repeatable. It's been based on just the luck of the circumstances. When did you buy? Oh, well, mate said something. When did you sell? Well, I was up a bit. It's not really repeatable. That's not a process. So a process is, well, I bought it because it did this, and I held it because it was doing this, and I sold it for these reasons here. So that all becomes part of a process. So that's what we want when we're looking at stocks. So it's really, I think, we want to systemize what we do. And so process and system, and as well as making something repeatable, when you can systemize something, you also de-emotionalizing the process. You're making it more about following steps than gut feel, about fear or about greed. It's about, well, what's the process say I should do next? And this is a thing. We don't know what the market's going to do next, but if we've got a good process, well, we know what we're going to do in every situation. If the market soars, we know what we're going to do. We're going to hold. If the market crashes, we know our stop losses are going to get hit and we're going to get out. And whatever else happens, it's all going to fit inside our systemized process. I think that's the best thing we can do when starting out. It's like, as you say, Rog, start to formulate some sort of process. Back testing is terrific, but it's not really accessible to a lot of people. I do a lot of back testing, but you've got to have the programs, you've got to have the data. It's not something someone starting out is really going to be able to do, but someone starting out can go and read books about people who have processes and start to adopt those good habits or those aspects which make what they do repeatable. And over time, as they build their skills, maybe they can look at something like back testing. But if you're taking on strategies which have a history of success, which others can demonstrate, well, then I think that's your starting point. And for me, it's like trading with trends, staying on trends, letting profits run, cutting losses relatively early, spreading risk. These are just overarching guiding principles. I think anyone can just take on board when they're starting and start to build the finer details around those.
Yeah, so it's a great response, and you, like I said, backtesting might not be that accessible. What about so we in the Self Wealth platform, you can actually have a virtual account, right? So it's not like you can buy and sell using that virtual account, but you can actually input the number of stocks that you want in that at the certain time, at a certain time, and you can also see over time if that stock's made money, and you can remove it from your portfolio, and you can do a bit of forward testing maybe. What about forward testing? I think to myself, if you're going to put money into something and it's the only money that you have to put in, so you don't want to lose it, or you try and avoid losing it, because you can't not, that might happen, right? But what about taking 6 months to really, like you said, study the books, understand the system you're going to go into with real money, and do a bit of forward testing? What's your thoughts around that?
So by forward testing, you mean paper trading? Would that be
paper trading? Yep. Another word.
Yeah, it's look, it's good. I think it's a useful tool. I think a limitation with paper trading is that it takes pretty much every aspect of emotion out of it, which isn't necessarily helpful, because you've got to feel the emotion of I'm always talking about reducing the emotion, but there's always going to be some sort of emotional imprint on us when we act in the markets. When you paper trade, it's nothing. You're not really accountable. There's no profit. There's no loss. You can make sloppy decisions and you don't really pay for it. Whereas you make a sloppy decision with real money, you pay for it, and that will hurt a bit, even though it it might be a relatively small loss and we can put it aside quickly. There's still an emotional imprint from doing something which just wasn't right. Paper trading, you don't really get that. So it can be good, I think, maybe for just learning some basics, but as soon as possible, I think you've got to get the trainers off and put some sort of skin in the game. Doesn't have to be a fortune. Just having something which is real makes you pay more attention, I think, to what's going on, and also understanding what time frame you're operating in, because you might read a book on trend following and go, "Oh, this sounds really good." Buying stuff which is rising and holding while it's working. But the 6 months you happen to test that process out with your real money, it happens to be a period like 2022, 23, where the market went sideways. And you're going to say, oh, well, that didn't work very well. The conditions just weren't suitable. So this is the beauty of back testing. I can get 30 years worth of data and I can test over various cycles. If you just come into the market, it's a bit of luck of the draw about what conditions you get. Do you get suitable conditions or not? So you've got to be able to, I think, stick with a process. If you think it's a valid process, you've got to be able to stick with it through a good part of the cycle to give it a fair chance. Otherwise, you might end up just walking away, going on to something else, and then what you were doing starts working, but you never know, because you've already discounted it after a 6 month window, which mightn't have been suitable.
Yeah, fair enough. No worries. Yep. I think they're very valid points, Jason. And I agree with you around the paper trading. You just can't feel the money actually going in and out. I think I liken the analogy to trying to learn to fly a plane. All right. I'm assuming you don't just get a process or a checklist in place and you got that process in place and you just go and fly that plane. Right. I'm assuming you do a bit of simulator training beforehand before you fly the plane, and then you go on it. Right. So that's the way I guess I kind of look at things sometimes. And even though I don't really do much paper trading anymore, I don't do any paper trading anymore. I just felt like you don't want to give someone who's never done it. I'd rather just say, go find the system, go read the books, do a couple, maybe even a month or two of seeing if you can follow your process with a virtual account. And then put your money in. It doesn't have to be years, obviously, but just then put your money in. That's all. That's the way I was.
I think you're right. I think it's good. I think it's good just to get a feel for what's going on. And once you kind of, okay, I know how to place an order, I know how to close something out, I know where to find everything. It's like, I think I understand my process now. I'll just start let's put a little bit of money into this and make it real. You're not putting everything in, but you're putting a little bit in, make it real. It's I've got into the sim for a 737, and it wasn't scary at all because I didn't leave the ground. I landed a 737 at Kai Tak in Hong Kong, the old airport in Kai Tak, in a typhoon, and that wasn't scary either. But if you put me in the real thing, it might have been it might have been a little bit scarier. So this is the thing: sims are great, and practicing is great, but it's no substitute for the real thing. So that's eventually you got to move to that real thing, but keep the stakes small. And if you keep the stakes small, baby steps, nothing bad can happen. So that's the way I'd approach it.
All right, fantastic. Thanks, Jason. I'm glad we answered all that. Now, can we move on to the markets, please? Let's have a look at the ASX. Thanks.
Right. Okay. So let's click over to our screens. And so the ASX 200, and it really does continue to coil up. Look at this this range we've been in for the last couple of months. The coiling continues, and the price action just keeps compressing. The highs are getting lower, and the lows are getting higher. So that's real compression in the price action. And the first thing on this this daily chart to notice is just in the last couple of weeks, we've had this gradual drift lower, back towards support at around 7,700. Got the moving averages, the 50 and the 100 day. Markets come back to that. And what's positive from this, I think, is that the dips continue to find support. And it's been interesting to see this occurring really all year. So every time the markets come back to these moving averages, we've generally found support. A little bit of overshoot in April, but again, generally support around these moving averages. So I think that's a positive thing. And so I think from that we can say that the underlying tone of this market, I think it remains bullish. From a near-term perspective, the ASX 200 is pretty much, look, I think we've got to say it's in a holding pattern. We're really waiting for it to break one way or the other from this range. But as I say, I think the underlying tone remains positive. The consolidation itself, not really a surprising thing to be seeing. Something we've spoken about quite a bit, I think, over the last few weeks. It's just a multi-month consolidation following a strong upward period, and this is what you get in markets which are in trends. They go through consolidations, and that's what we're seeing now. These consolidations are just part of the cycle. And the other thing to remember is that they often take time to play out. So 5 months of rising prices, it's entirely reasonable to get 2 months of sideway. But whether there's more consolidation to come or whether the price breaks higher in the near term, I think the overall structure, as I say, I think it's bullish. There's nothing here to suggest that the market's making some sort of a top at this point. So as we've talked about, Rog, quite a bit, my approach here has been just staying long the market, holding my stocks which have been doing well, using those wide trailing stops to try and see off this period of sideways consolidation. I've had a few stocks which I've had to exit over the last couple of weeks. Not many, only 2 or 3 or so. For the most part, most of my portfolio remains above its trailing stops. Some stocks are still making new highs, so I want to let them continue to run. And as always, it's managing risk. And this is one of the things which I think is really important. Is like I'm always preparing for when I'm going to be wrong. So I've got a plan for. It's not just about, look, I think this is going higher, I'm going to buy, and then not thinking of my downside. It's like, well, what if it doesn't work out? What if it starts to lose money? I want to prepare to be wrong, and I know I'm going to be wrong a lot when I'm in the markets, but I just want to be wrong a little bit and be right a lot. So this is why I use stop losses when something's not been working. Be a little bit wrong early rather than a lot wrong later. I think that's the key to longevity in these markets.
I like that. Be a little bit wrong early than rather than be a lot wrong later. I like that. That should be your quote, Jason. Philosophy on your website there. All right. And what about the US markets then?
Okay, jumping over the S&P 500, and the series of all-time highs continues. So Monday, yesterday, overnight for us, yesterday in the US, it was the 31st all-time high this year. Now, I think many people will hear that and go, wow, 31 all-time highs, surely this is about to end. It can't keep going on like this. But the interesting thing is when we look back through history, we do get these long runs of all-time highs on occasion. They do happen. So since 1950, so that's over the last 74 years, there have been 12 occasions when there have been at least 40 all-time highs in a calendar year. So Just say all of that again so people can take it in. Since 1950, there have been 12 occasions when there have been at least 40 all-time highs in a calendar year. So we're currently at 31. So that doesn't to say this is going to continue past 40. I don't know. No one knows. Last night could have been the top. Probably not, but you never know. But the point is, all-time highs tend to lead to more all-time highs. So the last big series was in 2021. We got 70 all-time highs in the year. And before that, it was 2017. There were 62 all-time highs in the year. And the record for all-time highs in the calendar year was back in 1995, where we got 77. So it puts the current 31 into some sort of perspective. It's a good run. We don't normally get that many in a year, but there have been lots more. And I think people often worry that when the market's at an all-time high, they think the top nut must now be close. All-time high must be near the end. But that's just often not the case. As I say, all-time highs, they often lead to more all-time highs. So, yeah, keep an open mind in terms of where stock prices could go over the rest of this year. And this is all playing out in the price action. I think as it stands, we've got a market that has just rallied off its 50-day moving average. And after a brief pullback to the 50-day moving average, rebounding off it, this remains a bullish chart structure with a clear upward trend. So that is currently the path of least resistance. I think the base case remains, and this has been pretty much since November last year when prices, they sold off, they got back above the moving averages in November. So pretty much since November, it's been a story of staying long and letting profits run. Same applies to the NASDAQ. That's been the trend. That's been the path of least resistance. It's interesting to see that, just quickly jumping over to the Dow, the Dow still isn't confirming. It's still below its recent highs. And we look at the S&P 500 on an equal weighted basis, and it's also below its recent highs. So I think this tells us that the broader market is still consolidating that big rally we had off the October low, and that's okay. That's what the ASX 200 is doing. It's consolidating, it's also interesting that another interesting fact is that around 50%, actually it's a little bit over, I think it's a touch over 50% of S&P 500 stocks are below their 100-day moving average. And that's not what you'd expect in a bullish market, but that's what we're getting in this market. And that's why we're seeing the equal weight tracking sideways, because you've got a lot of stocks which currently aren't participating. And that may prove to be okay if they stabilise and start moving up. But at the moment, the rally is a bit narrow. And so my preference at this point is to buy the components of the S&P 500 rather than just buying the S&P 500 itself. I'd rather be buying the stocks that are breaking higher, which are rallying off there, which are rebounding off moving averages, rather than just chasing stocks like Nvidia and Apple, Nvidia particularly, which has just been unbelievably strong. But it's if I had it, I'd be holding it. I'd be happy to hold a stock which is running hard, but I'm not always so keen to go out and chase a stock which has been running hard. So that's why I'd probably buy the components of the S&P 500 now rather than just buying the index. And also using those wide trailing stops to see off the pullback, which a lot of stocks are currently experiencing.
Yeah, very good. Actually, I've got a question here from Kirby around the your motion trader system, and maybe this is involving the back test. Have you ever run the motion trader system on a US stock portfolio?
The same principles apply, and it does the same thing. It identifies stocks which meet that criteria around the moving averages, around the 70-day high, and yeah, it works in US stocks. But my focus is on the local market. But it's very, very much transferable. You can take it to the UK, you can take it to Asia, you can take it to the use it locally. They're guiding principles that will work pretty much any market environment. It's just trading trends. it could be gold futures, it could be soybean futures, and there are trend following funds which do trade all these other commodity markets and currency markets and bond markets using these same principles around moving averages, around breakouts, around trailing stops. It's so it's not unique to me. It's not unique to Motion Trader. It's but what I do with Motion Trader, it's about I'm able to bring all those processes together and then apply them across the whole ASX, which is a bit harder for a lot of people to do individually. So I'm able to do that and provide that consistency to the entries and the exits.
Yeah, and have you been able to do any back testing on a US 20 years with the system at all?
I haven't done it for a long time, so I'm not current with any information on that. It's it's okay. I haven't done it for ages, so no, I can't really give it. I know it all works because I've done it. I can see that it has worked, but I haven't updated. I was using data from 15 years ago when I was doing this a while back. So I'm not current on backtesting results for the US.
No, that's okay. All good. No worries. And now, what about the Hong Kong markets?
And jumping to the Hang Seng, just another week of consolidation, really. I think it's encouraging that prices seem to be finding some support around the 50-day moving average. It's been really sitting around that 50-day moving average this week. I still want to play this structure from the long side. We've got this impulsive rally. So from April, I call this an impulsive rally. It's impulsive because there's no real overlapping of the price action. It's just it's a strong path upwards. Whereas when we look at this decline, there is a bit of overlap where it falls and is somewhat overlapped. And so this looks more of a counter trend sort of move that corrects the earlier advance. So I think the overall structure is positive. I think the key here is that we want to see prices ideally stabilize around this 50-day moving average, but most certainly above around 17,000. We can see this support coming across here. I think a break below there would really would almost I think it would probably nullify the bullish scenario for the time being. But we're a good way off that. So at the moment, I think it's a case of continuing to approach this with a positive viewpoint. Similar sort of situation over in China. I think the building blocks for an uptrend are there. Prices are still just above these moving averages, but really want to see them start to hold at this point. We've still got a series of higher lows and higher highs, which is always a positive thing to see. But it's really a case: is the market ready to continue building on this emerging positive structure that we can see? I think like Hong Kong, I think it's a case of still treating this as an emerging uptrend in the makings, and do that until the price action tells us otherwise.
Okay. All right. Fantastic. All right. Let's have a look at, first of all, some of the questions we've got here. All right. So one from Michael. With regards to risk management, how do I prevent and manage situations like the ASX and DRR always get hit from small gains to becoming bigger losses due to gapping down? Very annoying.
Right. Okay. We might jump to the chart. So ASX and DRR, is that right?
Yeah.
Look, gapping down's one of those things we can't. You often can't foresee it coming. Sometimes you can see a market is in a technically vulnerable position. But looking where the ASX was just prior to this gap down, it wasn't. It was consolidating sideways below moving averages, which were rolling over. So that was a warning sign. that it was possibly weakening, but you couldn't say from that it was about to gap lower. I could have looked at this and said, look, if it breaks below the low at around 61.20, maybe that would be an exit. But yeah, I wouldn't have been looking for a gap down. You just can't do much with that. Same thing back here in June 23. Like this could have been, we could have looked at this at the time and said, look, this is encouraging. It's gone from below the averages to above. It's pulled back. It's trading around the averages. It might be getting ready for another leg higher, but instead, it gapped. So this is going to happen. You can't avoid every negative situation, and this is why we spread risk. We have many relatively small trades. So when these things do happen, it's not the end of the world. It's a bit frustrating, but so be it. It's going to happen. And was it DDR as well, Rog?
DRR, sorry.
Is that it? DRR?
Yep.
Well, this one here is more a case of you could see the risk was there in that it the moving average had crossed, the price had been largely stuck below it. It was starting to unravel to the downside, and often when you get this, it's sort of like, I call it a waterfall pattern, where you get a decline and a rally, another decline, a shorter rally, a bit more steeper decline, and another failed rally, and then it gets to the point where the trapdoor opens and it falls away. So it's a waterfall cascading pattern. So if we were looking at this one, at where I've got a position on the chart now, I'd say, look, we've got downward momentum. The path to least resistance lower. The risk is there that it accelerates to the downside. It doesn't necessarily, but that was the risk, and that's what's happened. So it's about identifying where your exit point's going to be. Like, how long are you going to let a stock decline before you cut it? Like looking at how far this one had fallen from its highs, being below the averages. I think that was more of a situation which we could say, look, we should start managing our risk around this prior to this decline. ASX, well, it's a bit harder. It's sometimes you're going to get caught. It's harder to get around. But also sometimes we're going to see small profits become small losses. It's like you just got to give a trend a chance to go, and some trends won't go and they'll fall back and become small losses, and that's part of the process as well. We never know which trends are really going to get momentum. So it's a case of give them room to move, see if they really, really start to go. If they go, that's great. If they don't, well, you just close them out, small gain, small loss, and move on to the next one.
Yeah. Do you have the view over all these years? I mean, would you say the 80-20 rule applies to your portfolio, Jason? Or
yeah, very much. 20% of my stocks make up 80% of the gain, for sure. And that's typical of trend following strategies generally, in that it'll be the top portion of trades which will contribute the bulk of the profits. I saw something really interesting today, some research. It's like, I can't remember. There was a study of the US stock market over nearly the last 100 years, and it's like such a small percentage of stocks have made up 80% of gain or something. I can't remember the figures exactly, but it was something like, it was under 1% of stocks was contributing like 20% of the gain, and then the majority of stocks, I think it was like 55% of stocks over time had produced returns of less than bank interest rates, less than T-bills. So the majority of stocks underperformed, and of those that did outperform a basic interest rate, it's really only the top portion of the top portion which produced super gains. And this is why I say it's about spreading risk, because we don't know which stock is going to produce the super gain. And when we do get on one of the ones which is going to go a long way, we don't want to cap that profit by selling too early. We want to let it run, and just be prepared to spread that risk and try and get on those outliers. And that 80-20 rule is very, very much a thing for, I think, for probably for most successful investors. A small number of stocks are going to produce an oversized portion of their gains.
Yeah, and if you have that in mind when you're investing in trading and all that sort of stuff, then it sort of makes you a little bit more at ease at these annoying stocks that don't go your way, right? So yeah, if you've never heard of the 80-20 rule or Pareto principle, then look that up and have a read around that, because it's a great way of measuring, of being able to cope with these things, right? So
stocks like this one here we're looking at, it's just a stepping stone to the next 100% plus winner. You're going to touch on plenty of stocks that just disappoint, and they're okay. As we said earlier on, it's a case of be a little bit wrong early, and rather than a lot wrong later by holding on as some of these stocks continue to decline. So be a little bit wrong early, take your loss, stepping stone into the next stock, see how it goes, and then a percentage, if you've got a repeatable process, a percentage of those over time should deliver a large profit at various points, and they're the ones which are going to make your portfolio. And there's going to be plenty of muddlers in the middle that do a bit okay, or produce a small loss, and that's okay. They net one another out. All the gains largely come from maybe it's 10 or 20% of stocks which really do perform well. But you've got to be consistent. You've got to stick at it, and you've got to give your best ones. This is why it's so important. Let your winners run, because every stock is not going to go gangbusters. Most stocks will just not do anything overly exciting. And when you do get an exciting one, you don't want to cap it. You want to get everything you can from it.
Yeah. All right. Jason, how often do you use the weekly charts to judge an entry or exit?
Not very often. I like to look at a weekly chart to get perspective. Mainly on an index. I don't often look at a weekly chart. I'll compress the chart a lot, like this one doesn't have a great deal of history, but ASX does. So just because we're talking about ASX, we'll jump back to that. So I'll compress the price chart and just sort of see what it's done over the last few years. But I don't really need to see much more than that to form a viewpoint on it. Now, I could put it onto a weekly chart, and all this stuff back here from the late 90s, early 2000s, it's not really relevant to what's going on now. It's interesting, but it's not going to help with an entry or an exit. Likewise, all this stuff around the GFC, it's not really helping my current assessment of what's going on. So I'm happy just to look at this from a daily perspective and just say, look, we've had a big move up, large sideways periods, broken to the downside after that, after going sideways for a few years. It just hasn't been a stock to be in for a long time. It's mostly been below declining moving averages. Briefly, it looked like it might be getting going again in 21, but then before too long is back below the averages and back off the radar. So this hasn't been a place to really get much activity for a while. It did give signs earlier on this year that maybe it was going to get going again. The moving averages crossed. We got a break. Would have been a motion trader signal. Initially, it started to look like this is promising, but then just in the last couple of months, it's just been holding its ground. But then it quickly gave way, so it takes it off the table again. So the weeklies are interesting, but I think the dailies are, for the most part, more for me. For some people will like to look at weeklies and use longer moving averages, and that's fine. Different ways to look at things, but for me, I prefer the dailies.
Okay, fantastic. All right. Question from George. Any way to reduce the dips and the drawdowns if you are running an SMSF and don't have a lot of funds to play with?
Okay. Look, everyone wants to shut down volatility, and that's completely understandable. No one likes, the big swings in their portfolio. But the problem with trying to reduce the dips or reduce the drawdowns is that you've got to then have you've got to be quicker to get out of stocks when they turn down, and then you end up getting out of stocks on relatively minor pullbacks, and then the stock bottoms and then starts to rally again. So it's a difficult thing. It's hard to ride a large trend if you're always trying to shut down volatility. I think if we want to do individual stocks, I think we've got to be prepared to accept a degree of volatility. If you want to be in the stock market generally, you've got to be prepared with a degree of volatility. We can call up the ASX 200, and this is let's just put it onto a weekly. It's like that's volatility. There's volatility in this. Like looking at that, what's that? That's a 25% fall, so that's probably about 20%. This one in here, maybe that's around 10 to 15%. We've got COVID. That was about 40%. This pullback in the last couple of years, that got to close to 20%. That's the stock market. It's a volatile place, and the individual stocks tend to have even a bit more movement in them as well. So, yeah, I don't like. It's really hard to smooth out your equity curve so you don't have deep drawdowns, other than to like some people will use shorting strategies as well to try and take the edge off the drawdowns. But if you've got limited capital and you're using a self-managed super fund, well, shorting's not going to be an option anyway, and it's not a simple remedy either. Shorting's also comes with its difficulties. So I think it's a case of, if we want to trade medium-term trends, we've got to be prepared to sit through drawdowns, or we can't effectively trade medium-term trends. Unfortunately, I think that's the answer.
Yeah. All right. All right. Quick one around TradingView. What's your recommendation on the subscription, or what do you use? What kind of?
I use the one level offering. It's just basic. I don't need much. I just need to get the charts and put a few indicators on, and that's all I need. They've got higher tiers where you get more watch lists, or I don't know what it is. I haven't really looked at it because I don't need it. You can get live data. I don't need live data. If I need live data, I can just go to my self-wealth account and just see when I'm buying or selling, where the current price is, the market depth. The 20-minute delay is fine because I'm not actively trading off it. Looking at the chart for buy points through the day. If I was, there are times where I have needed live data for trading futures markets, but I'm just not doing that at the moment. So yeah, for TradingView, for me, just it's not very much. I don't know how much it is. Might be $10 a month or something. I'm actually not sure. You've got to check the pricing for yourself, but it's pretty cheap.
Yeah, we don't work for TradingView. This is not a plug for TradingView. We just use the TradingView charts. I'm the same. I just use one off. And to be honest, just start with one off, because you can always upgrade if you really need anything else. But I'm like you, Jason. I actually don't need anything else I've discovered. So I just don't like the annoying ads that come up all the time. So actually, that's why I paid for it, right? So yeah, very good. So all right, so let's get on to some questions. Some tickers now. Let's have a look. We're starting off here we've already had a look at a couple ASX and DRR, and you can see the sort of differences and why you would have got off DRR a lot sooner, potentially. But let's have a look at RAC to start off with anyway.
Yeah, okay. Let's just compress and see. It's well, this would be one. If I had it, I'd be holding it. So that positive structure we look for from below the moving averages, now above the moving averages. The moving averages cross. It's this similar pathway that we often talk about. It's like it's just breaking to a new high now. So I guess the stock could be bought at current levels, but you're buying into strength, which is all good. It's just like, how do you manage the risk around it? Look, there, you could have a stop back down to just below the 50-day moving average. It's 28%, so it is a reasonable stop now. I think my preferred way to have played this would have been just like a break above these highs, like whether you use some sort of a sloping line. Maybe it works better. Maybe something like that. Maybe which isn't that far from where it currently is. But yeah, there's the breakout point. So we've got the initial strong rally. We've got the sideways consolidation back to the moving averages. So it was a case of either, particularly this second dip, that was an interesting play there. Like, buying it on the second dip with a stop back below the 100-day, back below the previous low. That would have been an interesting buy the dip. Having not done that, then it's a case of, look to buy the breakout, have a stop back down below the 50-day. Maybe it's around 22%. So it's just probably a little bit more now with it breaking up again. But it's a stock which it's asymmetric in that you could see it's certainly got the potential to go back to a new all-time high. It's not to say that it will. It may fall completely short of it, but it's got the potential to do that, and it's got the upward momentum is very much to the top side. It's breaking out, it's above the moving averages, and the risk can be managed around it. So it's a stock worthy of consideration.
What about NXT? NXT.
It's a more mature trend in this one. It's been in place for quite a while. So this will be a motion trader stock. It's always harder. Like when I do the back testing, buying at an all-time high or buying at a 1-year high, it's a profitable strategy. But I know it's a harder strategy to do because people see all this way that's already gone and say, well, has it already had its run? And at some point, most of these stocks will make a high and pull back. We just don't know which high is going to pull back from. So it's an easy one for me in terms of, if I had it, it would be an easy call to let it run. Would I want to buy it at current levels? Well, theoretically, yes, you'd buy it because it's in an upward trend. It's not stretched above its moving averages. It's just whether you're comfortable buying it at a high level while the market's consolidating. Are there other opportunities that you're looking at? If you've got a choice of opportunities and you have to narrow it down, maybe it wouldn't be at the top of the list of opportunities. Maybe it would. I don't know, but it's not a standout for me. It's a standout. Let the profit run, but it's not a standout buy. It's not a real clear pattern that it's coming out of. It's like it's come back near the moving averages, but it's not like a range which it's been in for the last 3 months. It's just like the trend's gradually grinding higher. So it's definitely a hold. It's not an exciting buy.
Okay. All right. HLS, please.
So this one's been off the radar for some time with this declining moving average. Actually, we'll quickly jump to the weekly just because I want to see what's on the other side of here, just out of interest. So this is where a weekly can be interesting sometimes because you can just sort of like whereas with ASX, all the action from the weekly was down in the bottom left-hand corner, whereas this is more sort of relevant to where the current price is. I wonder whether they all line up. So there's a reason for having a look at the weekly. You can just see this big support base, which it tested 3 times since 2002. It's like a long-term level, but it's worth being aware of. Come back to the daily. It looks like it's starting to try and build, although For me, it's still a little bit early. It's above the moving averages. Moving averages haven't crossed yet. If you're using shorter moving averages, well, they may have crossed. Like if somebody was really keen and they wanted to get in this stock, well, I guess look, you could buy the emerging momentum and have a stop. Like you've got all these lows to choose from. It could be anywhere from say 20 to 25% below would be one way to play the risk on it, see if it goes. But for me, it's not enough of a break higher yet. Maybe there's a bit of a rounding base going on. Just looking at how do we draw that in? Yeah, you can generally see there's a bit of a rounding shape to that. So yeah, it's definitely one to watch. Whether someone wants to act on it now or not, it's like it could be a bit early. But then if you wait, well, then you end up probably paying a bit more to get in. So it's a bit of you've got to decide which way you're comfortable playing it. But yeah, it's definitely worthy of a watch list, and it's something where it's asymmetric in the making, in that we can see the downside is relatively limited, upside is open. This would be a level to watch. 180 as it approaches that, does it pause there? It's just a matter of whether it pauses there or goes straight through there if it gets up there. But yeah, interesting one, Rog.
All right. What about REA?
Trends up. So it's not dissimilar to was it Next we were looking at?
NXDC. Yep.
Yeah, not dissimilar to that. I like the structure a little bit more here though, because we can sort of like say, look, this has been range bound for the last along the same sort of time the ASX 200 has been paused as well, it looks like. So is this just another pause before, like it's on the verge of breaking higher, but hasn't quite broken higher yet? Yeah, it needs a little bit longer. So so maybe it's around 195. Maybe the breakout points, 195.60 or something like that, 195.70. Just giving a little bit more, then you say, well, look, okay, it's breaking out of a range. If I wanted to establish a position, I can get one. I can put my stop loss just back inside. Maybe just give back to the midpoint of the range, 50-day moving average. It's only about 6%. So it's looks like a relatively low risk play potentially, and you got the upside from it. Who knows what the upside is? There's no, it's new highs. Might just keep moving on higher for months to come. So it's definitely a hold for me, and yeah, for someone who likes it, it could be a buy. I'd probably give it a little bit longer just in case it tops here and then comes back in the range.
All right. What about VNT?
Yeah, it's upward trends there. It's a hold at the least. And like, do you buy this rebound off the 100-day moving average? Well, look, this could turn into a lengthier consolidation where it starts just moving sideways for a few months, or it could be like the situation back in August where it came back to just below the moving averages and then quickly started to rebound off it. Like, we don't know. We won't know until hindsight. But one possibility would be buying at current levels, stop below the May low, a bit below that. That's probably not too far away, and then maybe the trend re-engages. Or alternatively, it's like maybe it does trade like that's the possibility that it does, that we do just see sideways meandering for a bit of time, and then it could, after some sideways meandering, then start to break higher. So there may be more consolidation to play out. We don't know. So yeah, definitely hold. Could consider a buy and consider a stop down, like maybe around 338ish, 340ish thereabouts.
Okay. CSL.
Yes, this has been really range bound for over 4 years now. It's had a downward slope to it, but it hasn't had really strong momentum for several years. I do like. It's interesting. You can kind of on the downside. You can see this support, which was in place around 242.90ish. Had 3 good touches on it, came down. We got a false break to the downside, no follow through momentum, and then a snap back to above the moving averages, which is good. I like it when you get a breakdown of a meaningful level and there's no follow through selling. It seems to have been very much timed with what the ASX 200 has done. Peaked around the same time as well. So this is like, it looks, there's a good correlation to the ASX 200. The pullback looks corrective. So the main move seems to be up, the pullback corrective. So is this a process where it does start to lift itself out of this big range it's been in for 4 years? Quite possibly. It's I'd take an optimistic stance towards CSL here. Maybe this is the start of it starting to lift up out of this base. I'm more prone to say, look, I'm optimistic than I'm pessimistic. It's I'd give this the benefit of the doubt to the upside at this point.
Okay, that is very range bound though when you look at it over that period of time, right? So all right, QBE.
Long established uptrend. After saying I don't look at weekly charts, now I've looked at weekly chart.
Yeah, it's on your radar, obviously. Yeah,
and this is a worthwhile one to look at. So look, there's it like sometimes the weekly does help tell the story, in that like you can see how this has been a down and out stock since the GFC peak, and is this a large basing structure that it's starting to rally off? So just coming back to the daily, the trend is very much to the upside. It's a case of like letting the profit run. If somebody wanted to buy it, well, like similar to what we went through with NXT, in that it's at its highest level in several years. Whether it's at some point it will have a larger consolidation, but that could still be considerably higher than where it currently is. So it's near the moving averages. It could be bought at current levels with a stop, maybe using that low from May. So maybe just 10% below, and see whether this trend continues to move up. If it continues to move up, you let the profit run. If it comes back maybe 10%, maybe it's starting then to go through a larger sideways period, or even deeper pullback could unfold. But we don't know. The trend could just as easily just keep running, or the path of least resistance to the upside. So it's certainly a hold if somebody wanted to buy it for some reason. It's a point where it could be considered, but I just it doesn't. Don't see it as it's not a stock I'd probably be rushing to get into my portfolio. But if I had it in my portfolio, I'd be hanging on to it.
All right. We'll do a few here, and will be the last ones. IIQ.
We know where it's come from, so we're going to get rid of that so we can actually see the price action. Like this is one of those ones which I'm probably not going to get involved with. well, I'm not going to get involved with it. It's a really hard one. Look, it's just it's so prone to these spikes. It's had several of them. They spike up and then it comes all the way back down. I guess with this, it's like just looking at this history over the last few years. Once it's made it spike high, it doesn't revisit it within that movement. So it's had the spike high now. So if it were to break above this high from a week or so ago at 80 cents, well, maybe this time is different, and it is going to like lift off this what could be a base. It's not a stock I'd like. If you buy it now, say, okay, it's starting to break up, it's just having a pullback to the moving averages, is going to go again, where you can say, okay, I'll put a stop loss. It's still a decent stop loss. You're looking at over 30. You're looking at around 30% to get below the recent low, and it's 20% to below the 100-day moving average, and it's got a history of doing that. Spikes up, finds itself back below the 100-day moving average. So if you want to punt it, you can buy it now, put your stop about 20% below, but if it follows what it's done previously, it'll probably come down and hit that stop loss. That's why I say maybe the play would be, if you really wanted to get it, you buy a breakout above the spike high. If that happens over the next 2-3 weeks, then you say, look, this is a different setup to what we've had previously. Previously, it's given all those gains back. This time it's spiked, it's stabilized, that spike, it's breaking higher again. Maybe you want to run with that. But it's very, very volatile and risky one, which I'd probably leave to the side.
Yes, I don't like that one, but it's a funny one. Just a flat line down the bottom when you really expand out on it.
It's not a setup I like either. But when I look at these, I'm trying to look at the possibilities and go, look, can you see a pathway higher, and can you manage risk around that pathway rather than just saying, no, I don't like it. It's like, well, okay, it's like, yeah, it might be my thing, but how could someone manage a position around it if they've looked into all the fundamentals and they think this company's onto something? That could well be true. So, like, how could they play it? And that would be, if I was to play it, that's the way I would do it. I've looked at this patterns, how it's played out previously, and go, okay, that would be, for me, that would be the way to do it, buy a secondary break, which hasn't happened previously. And so that's it. We're looking for possibilities, and we're looking at how to play possibilities.
Great point, Jason. And then let's have a look at Yell, please. Yell. So we've got the rising moving average and prices above, and we're pulling back to the averages. So that's all fine. So we've got the makings of a potential upward pattern here. What we worry about here is, like, also we're close to resistance. We've got these previous highs. So what's most important? Is it the developing momentum, or is it the proximity to highs? So if I'd bought it as it was breaking higher a few months ago, I'd stay in it. I'd be in profit. So I go, okay, let's see whether it goes. And if I give back that modest early profit and end up with a small loss, that's okay. That's not a problem. I can live with that. That happens. That happens all the time. Modest profits turn to modest losses. No problem with that. So I'd let it run. Now, do I want to buy it here though? Do I want to buy it and put a stop loss just a little bit below the 100-day moving average? Like, do I want to buy this dip back to the moving average, have a stop loss, say 8% lower? We look at, like, okay, that's where the risk might be. Where's our upside? Now, upside at the moment, we've got an overhead resistance point not too far from where we are. So I'd probably wouldn't buy this dip at this moment, because I'm not buying into upward momentum, and I'm buying a dip which has overhead resistance not too far above it. So risk reward, it just mightn't quite hit all the
all the marks for me. So I'd probably leave this alone in terms of, would I buy it now? I probably wouldn't. No, I wouldn't buy it now. I'd rather see it consolidate around the averages, then start to break higher and get above this resistance. So I'm probably not buying it for a little bit yet, because this could also just be an ongoing large range. We could see this, back and forth within here for a while before then, maybe moving higher later in the year. But it could be via a trip back down to the lower end of the range. I don't know. It's too hard. I think this one's a little bit, the timing of it's a little bit tricky. But if I was in it, let's see where it goes. But be prepared for a modest loss if it pulls back. But if looking to enter, I'd probably just keep watching it.
All right. NTU.
Yeah, it's not working out. It like, this is the thing with momentum. Sometimes momentum can really start to lift off and continue running. Other times it comes straight back down. So when it comes straight back down, and this is the thing with low price stocks, and this is why I use a volatility filter with Motion Trader to try and filter most of them out, because they are prone to these erratic moves where they spike up and they come straight back down, like a 3.5 cent stock. Like, you can get some really nice setups with some of these low price stocks, where you get a breakout and you get a nice clean trend develop, but you also get so many more that are just prone to these spiky moves. So I'd have to leave this one alone. Couldn't even say buy the breakout above the previous high, because it's gone all the way up and come all the way back plus a little bit more. So yeah, for me, this is probably not the probably not an optimal place to be looking.
All right, RED.
Yeah, look, trends up. It's certainly a hold. Do you buy the dip back to the moving averages? It's a gold play. Gold's consolidating at the moment. Possibility of gold's consolidation continues on a bit. So I probably wouldn't buy the dip at the moment, because if gold continues to consolidate, it probably takes the wind out of red 5 sail as well. So I'd be inclined to say, yeah, I'd see if it was to consolidate sideways for a bit, and then if it then starts to break higher, that might be the setup to buy. So it's for me, it would be a hold, wide trailing stop, see if there's a larger consolidation, and maybe buy the breakout from the consolidation.
Fantastic. And then finally, DRE.
Let's see. It is, yeah. Look, you got these declining moving averages. It's hard. It's just like the moving averages haven't even really started to turn up yet. It's like a 0.5 cent above it. I don't see a high probability setup here. Like, even if you say, look, I'll buy it at current levels and put a stop below the recent lows, it's like, it's 35% just to do that, and there's every chance it comes back down and continues bouncing along the bottom. If for some reason you really thought that these guys are onto something, the market doesn't agree with that at the moment, but if you thought there was something there and you're happy to risk 35%, well, sure, you can buy at current levels and stop below the recent lows. And if they are onto something, it could quickly double. So you're risking 35% to maybe make 100%. So it's 3 to 1. But is that going to happen? You'd have to say the odds are against it. Just because it's trundling along the bottom doesn't mean it has to go back up, because some of these continue sideways and then ultimately disappear. So I'd leave it alone rather than chase the potential upside. I'd be probably too worried about the risk.
I love when you're struggling for words around a stock, Jason, to try and find a positive picture. I can already tell. It's funny because I can already tell where this is sort of going, and I think that's a great indicator of whether you like a stock or not. But I'm glad that you're trying to find and help people out in terms of how the potential manage risk around stocks if they are thinking about getting into it, which is great. So just remember, as always, anything we say or do is general advice. Please do your own research on anything that we've talked about on this show. It is your money, obviously, so be careful with it, please. And yeah, I've enjoyed another great session, Jace. Thanks for everyone for coming along, and thanks to continue. Hopefully, you'll be back next week. Obviously, doing the same, Jace. Now you're off for your run.
Yep, look forward to it. That was good. We got through plenty of stocks today, plenty of little side tracks down interesting paths, hopefully, and it'll be good to do it again next week.
Yeah, and are you going for your run now, or are you going for your run?
Yeah, the sun's come back out in Sydney, so that seems like a good play for the afternoon.
Oh, beautiful. Well, look, enjoy, Jason, and enjoy everyone else. Have a great rest of the week, and we shall see you next week. Don't forget, Jason's at motiontrader.com.au, and I'm at selfwealth.com.au. Just use the links and visit us anytime. All right. Thanks, guys. Have a good day. Bye-bye. Bye.